Welcome to the latest edition of The Bull, the Bear, and You as we navigate what is happening in the markets and also what is happening in the economy and how you should be investing. I'm Stacy Smith. Thank you for joining us, and I want to welcome our panelists once again, and they consist of Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, and Michael Godwin of Fregasso Advisors. You guys all have a good Memorial Day weekend?
Yeah, it was lovely. How about you?
I certainly did.
That's great. That's good. Well, let's talk about what's happening in the markets right now. As we always do, we begin with a look at the markets and where they have been the last 2 weeks or 17 days, and also where they could be headed. So, Michael, I will begin with you. Since the last time we met, I think there's a little bit of a dichotomy developing here, with the Dow losing more than 2% of its value, while the S&P 500 is up nearly 1%, and the NASDAQ has been setting new all-time highs and also is up nearly 5%, or make it 4%. So is there anything we should be reading into this or at all?
No, business as usual. Tech and communication services continue their decade-long outperformance. I mean, you still see that really play out in the markets this year. It's a little bit more broad-based than we saw last year. Stacy, if you guys, we talked about this, I think, a couple weeks ago, but it was the Magnificent Seven that drove the markets last year. You're seeing a little bit more broad-based this year, but nevertheless, it's been those really 5 of those 7 companies that have driven the performance of the markets this year, right? I mean, communication services, which is really Google, Netflix, Facebook, are the leading sector this year, and then tech is right behind it. That's, you know, your Amazon, Apple, Nvidia, which is essentially doubled again this year. I think what's interesting to note is the third best performing sector this year. The only other sector to outperform the S&P 500 so far through the first 5 months of the year. Anybody care to guess? Venture a guess?
I'll just throw it out because it's probably wrong. Retail, I don't know.
Close. It's utilities.
Utilities, yes.
The complete opposite end of the spectrum from tech and communication services. So I think that's kind of an interesting thing to point out here. I actually kind of like utilities right now too, especially if you think interest rates are likely peaking or close to that. And if you're going to get a sort of a growth slowdown here, utilities could be an interesting play in the markets going forward. But again, if you're not at least equal weight or even slightly overweight think and tech, that's where all the growth has been and really where all the growth is likely going to be going forward, I think.
I have to ask, and maybe all of you can jump in on this, why would utilities be going up? I mean, that's one that just doesn't seem to move much historically, right?
Yeah, it's a bond proxy for the most part. So if you think interest rates are going to start to come down a little bit, which, I mean, people, it's probably not going to come down as fast as you might have thought at the beginning of the year. But if you think rates are going to peak out and come down, since utilities are one of the higher dividend paying stocks in the market right now, and it's a bond proxy because to your point, they don't move that much, people will likely begin to trim their bond holdings and move into utilities. That's at least the thesis here, and that's why it's done. I think it's done somewhat well. It's also done very well because of the AI boom right now, right? You're going to need a lot of power to charge these data centers going forward, and I think those are the 2 big narratives as to why that's done very, very well this year so far.
I would piggyback on what Michael is saying. This kind of split that we've seen, bifurcation that we've seen with different types of stocks really lends itself to make us wonder if the economy is slowing down. And now we're starting to get data. We just had some data out this morning that suggests that the economy is not growing as fast as had been estimated. So today, we are seeing stocks not do well. We are seeing rates come down. And that's all because of the idea that, maybe we haven't escaped this recession after all. And this is just the beginning of some really soft economic numbers. Now, Michael made the point that going forward, we would expect to see technology and communication services, at least an element of them, continue to grow. And I agree with that because let's say we are headed for some softening, some economic softening, potentially a recession. I think this is really consumer-led. This is not necessarily corporate-led. And when it comes to technology, especially the fast pace of what's going on with technology, the integration of AI type components, AI computers that will be surfacing come the end of the year, I think corporations are still in pretty good shape in terms of where they'll be spending money and how they'll be spending money. So that will drive that sector versus the consumer that is now, still facing, higher real estate prices, mortgage rates, etc. So, we'll see what happens with these numbers. This was really kind of the first real wake up call, I think, in a while that might suggest that the economy is maybe softer than everyone thinks.
Well, we're due for a correction in the market under any set of scenarios, and it's turning into summer. And a lot of the pension money has been placed into the market. That's done by income tax time. And there's a lot of technical things out there that are probably taking away some of the buying inertia that has been driving the market for the last few months. You also have a situation where if you take those 7 or 4, whatever, depends on who you read as to how many stocks are doing it, take those earnings out of the S&P 500, and the other 490 some stocks actually have earnings going down, which that's surprising to me, actually. But I read that recently from a source that I consider reasonably accurate, if there is such a thing. And if that's in fact the case, which time will tell as the second quarter starts coming out in a couple of months, we'll see how that's doing. In fact, earnings are not as high as they were in 2022, I believe it was, for trailing earnings. Now, there's always anticipation of what the earnings are going to be going forward, but if what Carrie suggests might be happening, and there's reason to believe that might be happening, we will have maybe a slowdown in the economy and not a recession, maybe a recession. Who knows? We'll see. And if that's the case, this market, based on earnings and higher interest rates to discount them from, it starts not making a lot of sense until you look at stocks like NVIDIA, who grew their sales 100%. I mean, I've never seen growth like that. And quite frankly, I can't imagine it's sustainable. But when it comes to technology, I'm probably the last person you want to ask as to what will happen next.
Well, if you are right, Carrie and Frank, about the possibly heading into a recession or at least a pause in the economic growth here, that begs the question, and this is kind of off topic of what we were going to go, but you brought this up. Where do you go from now as an investor? Do you start to really fine tune what your holdings are just in case, or you just keep going as you are?
Well, for us, it's really about sectors. So I think that we've been a little ahead of the curve on, if interest rates are coming down. When we look at our bond portfolios, we've actually kind of increased our duration, meaning that if interest rates come down, we'll make more money on those bonds. I was at a conference last week and everyone's loving bonds right now. So I think that it's also, to Michael's point about, you look at those sectors that do hold up well during a recession. Utilities happen to be one of them. So you look at your sector exposures, and, it's some of those techie companies that are consumer led, like the Netflix of the world and so forth. That those consumer kind of discretionary techie companies that have run up, not that you get rid of them, but it becomes an inflection point where you rebalance them. You take some of your gains, you put it into areas of the market that maybe haven't performed well, and that can give you more stability throughout a downturn. But if you're really investing the way that we know works over the long term, which is asset allocation, you're not making dramatic changes. You're not getting out of the market and then getting back in. We really look at these times to make decisions about where we might want to rebalance.
All right, let me ask this question. Michael, I haven't heard from you for a while here because you're the first one that brought up about the utilities. All right, so if you do take a look at utilities, A, are there probably better utility companies to invest in than others? And then B, can you be hurt by investing in a utility?
Yeah, I mean, absolutely. Well, I'll take the second part of that question first. Can you be hurt? Yeah, I mean, utilities can be, especially if you're talking about relatively to the S&P 500. Since it's a sector, you can be hurt from a performance standpoint by lagging the S&P 500 by a great deal, just like any sector, right? Real estate is down like 8% this year, and the real estate equities versus the S&P up 10 or so. So that's a big divergence there. When it comes to which stocks you want to pick in there, I mean, I'm no utility expert, Stacy, but again, the ones that have done very, very well this year are those that are embracing sort of the AI fiasco that we're seeing in the markets right now. Those that are going to be providing energy to the data centers across the globe for sure. So I wouldn't generally pick individual equities there. I try to be a little bit more broad based if you want to play that sector. To Carrie's point, I think we're heading into what I call a quad 3 scenario where growth is slowing and inflation remains sticky. In that environment, utilities generally do well. Energy can do okay. Industrials can do okay, and tech can too. And you also want to move up in market cap exposure too. So you want to make all these tweaks. You don't be a hero in this environment. Make tweaks to your portfolio. I move up in cap, move up in quality, and be a little bit overweight those sectors that Carrie and I had mentioned.
All right, we have to take a break. We're way over our time frame, and we'll be back in just a moment. Welcome back to The Bull, the Bear, and You. We're having our discussions about the markets, where to invest, how to invest, and maybe what you should do and otherwise as far as your portfolio goes. My guests, as always, are Carrie Coghill of Coghill Investment Strategies, Frank Rossetti of HF Management Company, and Michael Godwin of Fragasso Advisors. Now, inflation has been remaining higher, as we've all mentioned just a moment ago. It's higher than the Fed wants to see, at least. And that means, of course, the Fed is keeping interest rates higher, which means that mortgage rates are higher. So, Frank, you mentioned mortgage rates the last time we met. And my question to you is, if this cycle continues where we have higher rates and people not necessarily selling their homes and people not being able to afford to buy one because of higher rates, will it have an effect, either good or bad, on different sectors of the economy and how you invest?
It will have an effect on the economy. It has had an effect on the economy. The biggest effect this real estate thing has had is it has held the inflation rate up where it is. This is, the food prices are weather related. And right now, I believe, I don't shop, so I probably should not say this, but I don't think food prices are going up that much these days. But that can change with these hurricanes and tornadoes and all this stuff. That's all fungible, and there's nothing anybody can really do about that. The weather is what the weather is. And so you just have to live with it as it goes on. But housing has gone up for two reasons. One, the cost of financing, and one, because I don't think one's more important than the other, the cost of construction has become pretty high, largely because we don't have a lot of tradespeople, and these men are making a lot more money than they ever did, and that's getting passed into the cost of the house. To bring out ancient history, I built a house in 1976 for about $25 a square foot. You're building houses today comparable to that for $250, $300 a square foot. And the high-end house is even more than that, depending on how high-end it is. And that being said, my house that I built in 76 was what then was a normal 2,400 square foot, 3-4 bedroom home. All right, it was 4-bedroom by design. I changed that, but that's irrelevant. And the point being, these costs require high incomes to support. And although incomes have gone up, I'm seeing Zillow feeds telling me homes that I would think should be trading for 200 or 300,000 in Greenfield, we'll say, I made that up, are trading for $400, $500, and $600,000. Well, I'm sorry, that's an expensive home for somebody who's making $50, $60, $70, $80,000. And that's not uncommon, $50, $60, $70, $80,000. So we have this dichotomy going on that's preventing normal waged people, average people, from buying homes just because they're expensive. The interest rate just adds to that problem. But to me, that's a smaller problem than the price of the property to begin with.
Yeah, I
So
don't think
sta-
that. Oh, go ahead, Carrie. Sorry.
Yeah. I was going to say, housing is a really important economic sector to watch, because what we know about housing is that it has about a 7 times multiplier on the economy. You buy a house, you go to Home Depot every night for like 3 months. My daughter will never step into another Home Depot, because when I bought a house when she was young, she was really sick of going there every day. Then you think about, you have to furnish it and everything else, and just that domino effect of what happens. And then even if you look at before that, just construction. So it does have an impact. And, as we saw this morning with some soft economic data, you start to wonder, are we really starting to see this? Because there's a lag effect. Interest rates go up. It takes a while to see the impact of that filter through the economy. I think the only factor that I would say may keep the housing inflation up is the fact that we don't have enough homes. So when you look at the supply demand imbalance as to the number of people looking for homes or household formation, and the number, what's out there inventory wise, we just haven't built enough homes.
But this sounds like a catch-22 though, because if as Frank pointed out, the cost of construction is so high, and the newer homes are going to be much more expensive than people can afford. I mean, am I reading that correctly?
Yeah, it really is a catch-22. So, housing is definitely something that we watch because of that multiplier effect.
Okay.
You're starting to see, the only thing I'd point out there is I actually think home prices are going to remain pretty firm for a while. You're not seeing a ton of single family homes being created, but you're seeing a lot of multi-family residential homes or units being created, whether it's like a 3-story building or 3-unit building, or even not necessarily the high rises, but a lot more multi-family residential real estate is being created now. So there's going to be more supply in that area coming onto the market. So that should help with your point, Frank, on the inflation and the inflationary aspect of that. But again, if you think about, just household formations, those are, since the pandemic, we're still running below our long run trend there. So I do think that's going to kind of revert back to the mean, where you're going to see more and more households forming, in which case you need to buy a new home. People aren't going to be leaving their homes, as we all know and quite talk about. I think homes without a mortgage are about 40% of all outstanding there. So you're just going to see still firm demand for housing. That's going to continue to keep prices at above kind of where we thought they would be, given the Fed has hiked rates so much. So I do think going forward, good or bad, home prices are going to remain pretty elevated.
All right, I'm going to throw this one out here, and I don't know that there are that many people that did this, but those people who did go in and buying a new home, since the Fed raised the rates and the mortgage rates then went up as well, a lot of them did these, I can't remember what the proper name is, flexible things where your interest rate is
mortgage?
Variable rate mortgages.
Variable rate. That the rates aren't coming down, and they're, if it was a 2 or 3 year variable rate mortgage, they're going to start hitting some higher mortgage requirements, and many of them are starting to say, we can't afford that. Is this going to have an effect at all?
I think it will. I'm in that boat.
Mm-hmm.
I have an adjustable rate, and it adjusts next year, so I have some decisions to make.
Yeah, but you can either refi again And rates aren't. It's not going to adjust to it. It's going to adjust to what level? Where rates are right now, 7% or so.
Yeah, there's a cap on
Yeah.
how much it can actually go up in any
Right.
one given.
And this isn't 2008 where people have 5 different properties and we're doing this. I mean, I think that's a small slice of the pie, Stacy.
Okay.
In regards to that, and again, home prices are much higher now. So worst case scenario, you'll likely sell your property to somebody else who needs a property, and the supply there isn't what it was back in 2008. So you're likely gonna, if you had to sell, come out okay in that event and then need to rent again. That's a terrible case scenario, but better than what happened in 2007.
To some degree, people bought a starter home that I would have looked at as an ending home when compared to what I did 50 some years ago. And that being said, it's not. I mean, that 2,400 square foot home today is being scoffed at, all right, by young people today. They're buying 3,500, 4,000 square foot homes, partly because they're working from home. So they're saving and commuting dollars, and now they're spending it by having a home that they can work out of with privacy. And, that's part of the equation. There's all sorts of dynamics going on here that didn't exist in the past. And it's really hard to figure out what's going to shake out simply because that dynamic didn't exist. They bought a bigger house because they're working there. Sometimes both people are working there. They need 2 offices on opposite ends. If it's like me, it'd have to be on opposite ends of the house because I'm loud.
All right. We need to take a break. We'll be back in just a moment. Welcome back to The Bull, the Bear, and You as we talk about the economy and investing in your portfolio. Carrie, this is one that was a topic in the Wall Street Journal, a column that was in the Journal a couple of weeks ago. I'd like to bring up to you. One reader who wrote to a columnist there said that she felt she had been scammed by a financial advisor who convinced her to invest $500,000 in annuities at the age of 35. And she said that it took her 10 years to get her money back. And she feels that if she had not invested in the annuities at that time, she would have had more in her savings or her portfolio or whatever you want to call it at that point than she did by investing in the annuities. So my question is there a good time to invest in annuities as far as your age goes?
Well, I mean, that's a loaded question because there are so many factors.
Me ask a loaded question? No, come on.
There's so many factors that go into answering that question. I do think that annuities have gotten a bad rap over the years, and rightfully so, until more recently. They came with much higher hidden fees. But there are a lot of things you need to know about annuities. When you buy them, there may be a surrender charge, meaning if you take the money out, you're going to pay a penalty. That money, the good things are the money grows tax deferred. Potentially at some point, you can do what's called annuitize it and get a stream of income for a certain period of time, the rest of your life, whatever the case may be. So people that don't have pensions and want to have some security of cash flow during retirement, they like annuities potentially for a piece of their portfolio. And, you have to really be careful if you're investing in annuities at a young age. I mean, the good news is that's a long time for deferral of taxes. And the compounding effect of that can be significant, but it's a long time. So you have to make sure that this really is retirement money that you're putting aside, that you understand all the fees, that you understand all the restrictions, that, an annuity, basically, if depending on the type, you can have the same options or very similar options in a variable annuity where you're picking mutual funds just like you would outside of, in a regular account, but you're getting the tax deferral of income. And if you're in a high income tax bracket, that may work out very well. So I can't say it's a good thing or a bad thing. It really depends on circumstances. The thing that our industry has not done well is actually transparency of being able to communicate all these things and educating the consumer about what they are actually buying, because there are a lot of ins and outs.
And that's where the problem lies. Most people are looking for a simple answer. In the case of annuities, there is no simple answer. They are complex products that offer benefits to certain people. Personally, I think from my experience, people that are in high income tax brackets when they're working are likely to be in, and if they're entertaining the thought of buying an annuity, they're probably going to be in high income tax brackets when they retire. And when that happens, this money starts coming out as their quote pension, and they're going to pay tax on a lot of that money simply because they deferred tax. It works kind of. Now I'm not going to say this because it's as much not true as it is true, so I better not go there. All right, it's deferred income tax as well. So you've got, if you put 10,000 in and you do really well and it's worth $250,000, well, 95% of the money you're going to take out is going to be taxed as a high bracket. Whereas if you did
Isn't that the same as an IRA though, Frank?
100% of an IRA is taxable. I was going to say that, and I backed off because 100% of an IRA is taxable. The annuity is taxable until you've taken the profit, and then what you originally put in is no longer taxable because that's your basis. Now, how long that takes is really depending on how you do it. Now, if you annuitize, there's a formula that you do. A lot of it will be taxable, but not all of it because it comes out on an annuity, and you can engineer that as well. I read that article as well as you did, and all I was thinking is she took 10 years to get her money because she didn't want to pay we call it a penalty. It's a deferred sales charge. When you put your money in, nobody took 3 or 4% off the top. All right. Whereas this insurance agent got paid. So the insurance company fronted that thing. And if you leave early before they have a chance to recover that, they're going to charge you to leave. So it's a deferred sales charge. People don't like to pay that. And rightfully, understandably. And so they take 10 years, which that's pretty long for the deferred sales charge, but it's not that uncommon. And to get all of her money out without paying that, it took her 10 years. That's the way they work. It wasn't because she lost the money. It was because she didn't want to pay the deferred sales charge. And she could take 10% out. Most contracts allow 10% a year to come out without paying that, which is a liquidity feature if you're using it properly. As Carrie said, it's a pension plan. It's not an investment plan.
Well, I mean, it's a pension plan, but depending on the type of annuity, it can be an investment plan if you have a variable annuity. Now, to Frank's point, they come in all different shapes and sizes. Nowadays, some annuities are fee-based, which means that they're not giving you that long surrender and they're not charging the high fees that they used to charge. And that's why I go back to, if you're going to buy an annuity, you should know all of the right questions to ask. And we can get into that another time.
Yeah. Michael, you have anything to say about it?
Not a thing. I don't do much in annuities, and Carrie and Frank know infinitely more about them than I do. So I'm going to defer to these two.
All right, we have about a minute to go. I'm going to throw this one out very quickly. I believe it is BlackRock that has already started a kind of 401k where you would do the ETFs or however else you want to do it, and then you're also able to get into an annuity toward the end of your years of working, maybe 55 or whatever. You guys like that idea at all?
There's nothing new about that.
It's not been offered, though, in 401ks before to go into an annuity.
There's self-directed 401ks. They're not common because they're really difficult to administer, but they exist.
Okay.
There's no reason to put an annuity in a 401k because it's already tax deferred. So we see sometimes, and again, back to like why you need to know the questions to ask, we'll see people put annuities into IRAs and it's like, why? It's already tax deferred. So I think what they're trying to do is, give some options for, I don't know why you would do that unless you just want the features of an annuity going into retirement, which again goes back to, is it right for the right person?
And perhaps BlackRock has found a way to make some more money too by doing this.
Well, that-
Probably.
No way.
No way.
that's a very cynical comment. Everybody does these things to
Oh,
make money.
absolutely. Absolutely. I know.
Except for the three of us. We're the four of us. We're doing this for nothing.
Yeah, I know. We are. So, again, maybe we'll make a around the table stock and then we'll try to sell it and we'll lose money on that one as well. All right. Thank you so much for joining us. And I want to again thank Frank and Carrie and Michael for being with us. And Kim couldn't be with us this time, but she'll be back with us the next time. So we hope that you join us again then. Thanks for joining us for The Bull, the Bear, and You.